Imagine standing in the shadows of a candlelit coffee house in Amsterdam, the year 1602. The air thick with tobacco smoke and whispered conspiracies. Around rough wooden tables, merchants huddle over papers that would birth the world's first corporation and stock exchange. But what they created was not merely a system of investment. It was a machine for manipulation, deception, and financial warfare that would plague markets for centuries. The Dutch East India Company's shares would become the first instruments of coordinated market manipulation, insider trading, and pump-and-dump schemes. The stock market, humanity's greatest wealth creation engine, was forged in darkness, built on lies, and operated by men who understood that information was the ultimate weapon. This is the untold story of how the financial system we depend on today emerged from a world of corporate espionage, government corruption, and systematic fraud that makes modern scandals appear quaint by comparison. Before we journey into the shadowy origins of stock markets, take a moment to subscribe to this channel and hit the like button. We explore the hidden financial histories that shaped our modern world, uncovering the stories that textbooks rarely tell. The Dutch Republic of the early 1600s existed in a state of perpetual war with the Spanish Empire, fighting for independence while simultaneously competing for control of lucrative Asian trade routes. Traditional methods of financing expeditions had proven inadequate for the massive capital requirements of intercontinental commerce. Wealthy merchants faced enormous risks, sending ships around the Cape of Good Hope to the Spice Islands of Southeast Asia. A single voyage could take years, and investors had no guarantee their ships would return. The solution emerged from necessity. The Verenigde Oost-Indische Compagnie, or Dutch East India Company, would become the world's first multinational corporation and joint stock company. But this innovation came with an unintended consequence. By allowing shares to be traded freely among investors, the Dutch inadvertently created the world's first secondary market. What began as a practical solution to fund risky voyages quickly evolved into something far more sinister. The Amsterdam Stock Exchange became a playground for speculators who had no interest in spices or trade routes. They were interested only in manipulating share prices for profit. The Dutch East India Company's shares began trading in 1602, and within months, sophisticated manipulation schemes emerged. Isaac Le Maire, a disgruntled former director of the company, orchestrated the world's first recorded bear raid. Le Maire had been expelled from the company's board after disagreements with other directors, and he sought revenge through financial warfare. He began selling shares he did not own, a practice now known as short selling, while simultaneously spreading false rumors about company disasters. Le Maire hired pamphleteers to distribute fake news about shipwrecks, attacks by pirates, and failures of trading missions. He bribed clerks to leak confidential information and paid informants to report fictitious disasters from the East Indies. The manipulation was so effective that share prices plummeted, allowing Le Maire to buy back shares at dramatically reduced prices and pocket enormous profits. But Le Maire's schemes went beyond simple market manipulation. He organized the first investment syndicate dedicated to driving down stock prices, recruiting wealthy merchants to join coordinated attacks on the Dutch East India Company's share price. This group, known as the Bears, would become the prototype for every market manipulation ring that followed. The success of Le Maire's manipulation tactics inspired countless imitators, and by 1610, the Amsterdam Stock Exchange had become a battlefield of competing manipulation schemes. Professional speculators developed increasingly sophisticated methods of market manipulation. They created false identities to hide their trading activities, established networks of informants throughout Europe and Asia, and developed coded communication systems to coordinate their attacks. The manipulation reached such extremes that the Dutch government was forced to intervene. In 1610, authorities banned short selling, making it illegal to sell shares without owning them. But the ban proved impossible to enforce. Traders simply developed new methods to circumvent the regulations, using complex derivative contracts and forward agreements to achieve the same effect as short selling. The government's attempts to regulate the market only succeeded in making manipulation more sophisticated and harder to detect. Meanwhile, genuine investors found themselves at the mercy of professional manipulators who possessed superior information and resources. Small shareholders discovered that their investments could be destroyed overnight by coordinated attacks from wealthy speculators with no stake in the underlying business. The stock market had become a zero-sum game, where profits were extracted not through productive investment, but through systematic deception and market manipulation. The turning point came in 1672, during the Dutch Golden Age's darkest hour. France, England, and several German states simultaneously declared war on the Dutch Republic in what became known as the Year of Disaster. As foreign armies approached Amsterdam and naval blockades threatened Dutch trade routes, panic seized the stock market. Share prices of the Dutch East India Company collapsed as investors rushed to sell their holdings. But this crisis revealed the true nature of stock market manipulation. Rather than reflecting genuine economic conditions, share prices were being driven by coordinated attacks from enemy agents and domestic speculators working in concert. French spies, funded by Louis XIV's treasury, had infiltrated the Amsterdam Stock Exchange and were systematically spreading false information to destroy Dutch financial confidence. English merchants, despite their countries being at war, secretly collaborated with Dutch speculators to profit from the chaos. The stock market had become an instrument of economic warfare, where national enemies could attack a country's financial system without firing a shot. The crisis exposed how vulnerable stock markets were to manipulation by hostile forces, and how easily financial panic could be weaponized against entire nations. The aftermath of the 1672 crisis fundamentally changed how Europeans understood stock markets. The Dutch government implemented new regulations, but the damage had been done. The concept of stock market manipulation had spread throughout Europe, and each new exchange that opened learned from Amsterdam's dark innovations. When the London Stock Exchange emerged in the early 1700s, it inherited all of Amsterdam's manipulation techniques while adding new ones. The South Sea Bubble of 1720 demonstrated how these methods could be scaled up to manipulate entire national economies. British politicians, including members of parliament and even government ministers, participated in coordinated schemes to inflate stock prices before dumping their shares on unsuspecting investors. The French Mississippi Bubble, orchestrated by John Law, showed how central banks could be used as tools of market manipulation, creating artificial money supplies to drive speculative frenzies. By 1750, stock market manipulation had become institutionalized throughout Europe. Professional manipulation rings operated across multiple countries, sharing information and coordinating attacks on targeted stocks. The techniques pioneered in Amsterdam had evolved into a sophisticated financial warfare system that would plague markets for centuries. The legacy of these early manipulation schemes extends directly into modern financial markets. Every major market manipulation technique used today can trace its origins back to 17th century Amsterdam. The pump and dump schemes that plague cryptocurrency markets follow the exact same pattern as Isaac Le Maire's bear raids. Modern high-frequency trading firms use algorithms to execute the same coordination tactics that Dutch speculators achieved through coded letters and secret meetings. The information warfare that drives modern market volatility operates on principles established by French spies and English merchants during the Anglo-Dutch Wars. Even the regulatory frameworks designed to prevent market manipulation are responses to techniques pioneered centuries ago. The Securities and Exchange Commission's rules against insider trading directly descend from Dutch attempts to regulate information asymmetries in the 1600s. Short-selling regulations trace back to the 1610 Amsterdam ban that proved impossible to enforce. The fundamental tension between free markets and fair markets remains unresolved because it emerged from the stock market's original sin, The system was designed by and for manipulators. Modern markets may be more sophisticated, transparent, and regulated than their 17th century predecessors, but they operate on the same basic principle that information is power, and those with superior information will always find ways to exploit those without it. The lessons from the stock market's dark origins remain as relevant today as they were 4 centuries ago. First, market manipulation is not a bug in the financial system. It is a feature that was built in from the beginning. Every attempt to eliminate manipulation has simply made it more sophisticated and harder to detect. Second, information asymmetries will always exist, and those with superior information will find ways to profit from it, regardless of regulations. The key is understanding that markets are not neutral mechanisms for price discovery, but battlefields where different groups compete for advantage. Third, the most dangerous manipulators are often those closest to the system itself: corporate insiders, government officials, and regulatory authorities who can shape markets through their decisions and access to confidential information. Fourth, market panics are often manufactured events designed to transfer wealth from small investors to large speculators. Understanding the historical patterns of manipulation can help modern investors recognize when they are being targeted. Finally, the stock market's dark origins remind us that financial systems are human creations, shaped by the motivations and moralities of their creators. The Dutch merchants who invented the stock market were not trying to create a fair system for everyone. They were trying to solve their own funding problems. The manipulation, fraud, and deception that followed were natural consequences of a system designed without adequate consideration of its broader social implications. Today's investors must navigate a financial system that retains the DNA of its manipulative origins, making historical knowledge not just interesting, but essential for survival.